Welcome to the price tag of the stock market. This video is about mastering the PE ratio to determine if a stock is cheap, expensive, or a hidden gem. Price tells you what you pay, but value tells you what you get. A $100 stock isn't expensive if it pays for itself in 10 years, compared to another that takes 100 years. You must compare the price to the earnings output. The PE ratio, or price to earnings ratio, is calculated by dividing market value per share by earnings per share, or EPS. If the PE is 20x, you are paying $20 upfront for every $1 the company earned this year. Let's look at a real-world example with FedEx Corporation. A stock price of $228.05 divided by EPS of $16.81 results in a PE ratio of 13.57x. Investors are willing to pay $13.50 for every $1 of profit FedEx generates. The PE ratio represents the payback period. If earnings remained constant, a PE of 13.5 means it would take 13.5 years to recoup your initial investment through company profits. This is the FedEx break-even point. Interpreting the PE involves looking at high versus low numbers. A high PE suggests investors expect high growth, or the stock may be overvalued. A low PE means the stock is on sale, or the market thinks the company is in trouble. The golden rule is to compare apples to apples. For example, Marathon Petroleum has a PE of 23.38, while Hess Midstream has a PE of 15.48. Hess looks cheaper, but a PE is meaningless without industry and market comparisons. There is the trailing PE based on the last 12 months, and the forward PE based on analyst estimates for the next 12 months. If the forward PE is lower than the trailing PE, analysts expect earnings to grow. The PEG ratio is the PE ratio divided by the annual growth rate. It adjusts the PE for growth. A PEG under 1.0 is generally considered undervalued, suggesting a high PE may be justified by massive growth. The PE ratio fails when a company is losing money or is a brand new IPO resulting in N/A. Also remember sector bias. Never compare a tech stock to a telecom stock, as each industry has its own normal PE. PE is not a universal hammer. For unprofitable startups, use price to sales. For banks and factories, use price to book. For utilities with high debt, use EV/EBITDA. Use the right metric for the job. Here is your value shopping checklist. Check the PE, compare to peers and benchmarks. Look for growth using the PEG ratio and watch for traps like an NAPE for unprofitable companies. The bottom line is the PE ratio tells you what the market is willing to pay today for the earnings of tomorrow. Use the PE to find the right questions. Is it cheap because it's a bargain or because it's broken?